Alright, so welcome back to another video on how to secure yourself financially, especially looking at the investing classroom for Morningstar, this North American company firm providing financial education and management portfolio and some other financial service to their customers and investors. So by looking at the featured content, where inside of this course we have seven sections: staying investment in the market, market on terms and recovery, asset class on terms, risk and volatility data, investment strategy for dealing financial volatile markets, don't focus too much in the short term, and dealing with financial stress. So the staying investment in the market sections, the TLDR or the things to know is that stock has provided the highest return and increase in the wealth over the last 94-year examination of the past capital market return. And investor must have discipline and patience, especially for dealing market downturns where the king is or where the king is spreading their investments by diversifying their portfolio in DCA, dollar cost averaging, which involving continued purchase regardless price fluctuations. A keyword or a word for that is a diversified portfolio won't eliminate risk, and DCA won't protect you or ensure you profits during market downturns. Okay, then I look at that holding on can pay off in the long run by looking at the crisis and long-term performance section, and that after the end of a recession, small cap stocks, small caps mean is companies that are between 250 million and $2 billion. So on average, the accumulated return perceived by these small cap stocks outperform those of the large stock after 1 month, 6 months, a year, and 3 years after the end of a recession. Okay, and how important is to understand interest rates because the Fed, the U.S. Federal Reserve, which was founded in 1913, that it established the discount rate, the interest rate, either this is a, either an interest rate that the Federal Reserve charge banks for short-term loans, and this rate is used in the discount cash flow analysis, right? And the discount future cash flow analysis or discount analysis is just an evaluation method to determine the value of an asset or an investment today based on its expected or based on its future expected cash flow. And cash flow is the movement of money in and out of a company, right? I also dedicate time to look at the beginner guide to financial statements from the sec.gov, something I'm going to talk later. But that's one of the things that the Fed does: set the discount rate, the the prime rate, which tells commercial banks the rate at which their most creditworthy clients will be charged, usually companies or corporations. It also oversees the nation's activity or the economy activity in the nation. It set monetary policy. It also prints money, and try to achieve something called the federal fund rate, which is the rate at which commercial banks lend fund each other overnight, and he tried to achieve that target by buying and selling security in the federal open market. And it's important to understand that this loanable fund market, which is also affected by the state of the economy, much like the stock market, and the inside of this market, you have different interest rates reflecting loans of risk and time length, right? So an example of short-term interest rate is Treasury bill, the federal fund rate, and one-year government maturity bonds, right? The key here is to understand that in the loanable fund market, that is also affected by the state of the economy. Okay, so you have contraction and expansion, and that leads to this second section, market downturns and recovery, and to understand that from a broad perspective, see how the market performs, and for investor who wants to have or who have long-term horizons or want to hold long-term investments, see how risk decrease over time, and by looking at historical data over the last 49 years examination of the past contraction and expansion from the stock market, see that after a contraction that there have been 10 market contraction. After a contraction, it marks the end of a market cycle, meaning the complete round of price fluctuation of a stock. Uh, and these cycles may vary in time and duration. So understand this and the contraction, what contractions mean in the context of finance, especially on stocks. So contraction is when the stock market peak value fall 10% or more. And again, this contraction may last for a different period of time, and they happen at randomly phased, right? According to Morningstar. Uh, and the expansion, which measure is the recovery of an index from the very bottom of the contraction from the previous peak and the subsequent performance until the next level of peak before 10% decline. So the whole idea of an index is this statistical reference that are expressed as percentage in a period of time. The whole idea of this index is to measure progress, and the recovery where is the upswing in price security following a long decline, right? And the term is also used to describe is the economy nations activity or the boom economy nations activity. Okay, so that is market contraction and expansion. And then I look at the market downturns and recovery. This is something that struck me the most because once I look at that in the US equity market, and equity is the total amount of asset minus its liability, that's one definition, one context, the total net worth of a business, or the uh, the amount of share that you own from a company, or in the context of property, is the total value of the property minus its liens. So what liens are? You know, So liens are just a legal right of someone else to possess your property until a debt is repaid or an obligation is met. And there's several types of liens. So you have bank liens. So anytime you ask for a loan to purchase, let's say, a car, you have a lien attached to that because the bank want to make sure that you're able to pay that. And if you're not, then they will seize your assets, some assets you have, to repay the debt and sell it. So they will seize that asset or that car to repay the debt by selling the car in that context, right? You also have judgment liens, which are usually or this is something that happens on court. Okay, so a judgment lien can be issued to a defendant uh, when there is a no payment agreement to seize some of the assets, to seize and liquidate some of the accused assets. You also have the mechanics lien, which the term mechanic is go back to the word when Thomas Jefferson defined that gentrified land, and gentrify is the land of noble people or people that have a higher social status. Uh, that doesn't mean that they are efficient or effective or they know how to administrate resources. That's another different topic, man. But in any case, so gentrification means the process of transform the an econ or a community with a more affluent people while displacing the old neighbors. But in any case, understand the mechanic liens, which is tied um, to builders, construction, or construction firms to guarantee that the owner pay for that construction or fix. So that's mechanic liens, right? You also have is interesting, and I think this is very important. Lien. No, it's lien. Okay. Bank lien, judgment lien, mechanic lien, real estate lien. Okay, and a real estate lien is a legal right to seize all and sell real estate property. Very important. So, so a real estate lien is a legal right to seize and sell real estate property if a contract is not fulfilled. So if a contract is not fulfilled, in real estate lien is a legal right to seize and sell the real estate property if a contract is not fulfilled. Some real estate liens are automatically put in place, such as the case of mortgage. So anytime you ask for a mortgage or you have a mortgage, there is a real estate lien tied to that. A loan used to purchase or maintain a house, land, or other type of real estate secured by the property itself. Okay, so that's a mortgage. A loan used to purchase or maintain a house, a home, land, or other type of real estate secured by the property itself. Mortgage are loans that are used to buy homes and other type of real estate. The property itself serves as a collateral for the loan. Mortgages are available in the variety of type, including fixed rate and adjustable rate. The cost of a mortgage will depend on the type of loan, the term, such as 30 years, and the interest rate that the lenders charge. Mortgage rates, in fact, mortgage rates can vary widely depending on the type of product and the qualification of the applicant. How mortgage work? Mhm. Okay. How mortgage works in the mortgage process. So it's a loan. It's a loan used to purchase or maintain a home. Mortgage. In Spanish, this is hipoteca. In Spanish, is hipoteca. Exactly. Exactly. Hipoteca in Spanish. Okay. Interesting. How to borrow in Spain? Your mortgage. Okay. So a mortgage is a loan to purchase or usually to purchase a home or maintain land or other type of real estate. So they basically is just speculating with that. Yeah, yeah. So they're basically speculating is with the price of a house or land. They're basically speculating. Okay, okay. So that's a mortgage. So yeah. So real estate lien is a legal right to seize and sell real estate property if a contract is not fulfilled. Okay, and some real estate liens are automatically put in place, such as the case of mortgage lien. So anytime you ask for a loan to purchase a house or to maintain a home or buy a land, you automatically have a lien to that, a legal right that whoever you ask for that money is in their legal right to seize that until that debt is repaid or the obligations are met. Okay, so when a party borrows money from a bank to purchase their home, the bank places a lien on the house until the mortgage is paid off. Yeah, when a party borrows money from a bank to purchase their home, the bank places a lien on the house until the mortgage is paid off. Okay, exactly. Exactly here. So when someone borrow money from a bank to purchase their home, which is something that my parents did, so they ask a Jesus, Jesus. So we are in this fucking game. Okay, 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 okay. Oh my fucking god. Oh my fucking god. All right, all right, all right. Jesus, love the game, man. Love the game. All right. So a real estate is a legal right to seize and sell a real property if a contract is not fulfilled. If a contract is not fulfilled, so a lease is legal right to seize and sell a real estate, you know, a real estate property. And some real estate liens are automatically attached or are automatically put in place, such as in the case of mortgage liens. When a party borrows, when someone borrows money from the bank to purchase their home, the bank places a lien. The bank places a lien on the house until the mortgage is paid off. Question is uh, unless you improve your productivity or find ways to earn money easily. I see you, uh, drug dealers. Uh, you are able to pay that. So there are several ways of you how you can improve your money game, right? Being efficient is one of them. Okay, nepotism, the old trusty one. Nepotism, improve or you improve your productivity, uh, or you find a product that sells without anything, you know. And it is funny because that is something that will be, you know what, that is funny because that's something that will be applied for example, in the case of drugs. But that is something that people will buy that. So you have the perfect candidate, you have the perfect client for that, you know? And not only that, if you sell that, so there is no need, that product doesn't need marketing. Itself. Itself. Okay. So, in any case, so this is the type of liens uh, that exist, right? You have bank liens, judgment liens, mechanic liens, a real estate liens is a legal right to seize and sell a real estate property if a contract is not fulfilled. So some liens or some real estates are automatically put in place, such as such as the case of mortgage. So when someone asks money to a bank to purchase a home, on the bank place a lien on that home until the mortgage is paid off. Mhm. So, however, some real estate liens are due to non-payment to a creditor or financial institution as a result, are involuntary or non-consensual liens. Okay. And then you have tax lien, which this comes from the law instead of created by a contract. And these liens are very common in the field of taxation. Okay, so where law often allow tax authority to put liens on the property of delinquent taxpayer. For example, municipalities can use liens to recover unpaid property taxes. In the United States, if a taxpayer becomes delinquent and does not demonstrate any indication of paying own taxes, the IRS may place a legal claim against the taxpayer property, including the taxpayer home, vehicles, and bank accounts. So, including the taxpayer home, vehicles, and bank accounts. A notice of federal tax lien notifies creditor of the government claim and can lead to a sheriff's sale. A sheriff's sale is a public auction whereby assets are repossessed, sold, and then generate funds that are used to repay a debt to a creditor bank or the IRS. So a tax lien is something created by the law instead of a contract, and they usually, or these liens are very common in the field of taxation. So where law often allow tax authority to put liens on the property of delinquent taxpayer. Okay. So in the United States, if a taxpayer becomes a taxpayer, so in the United States, if a taxpayer becomes delinquent and does not demonstrate an indication of paying own taxes, the Internal Revenue Service may place a legal claim against a taxpayer property, including the taxpayer home, vehicle, and bank account. Mm, a notice of federal tax liens notifies creditor of the government claim and can lead to a sheriff sale. So a sheriff sale is a public auction whereby assets are repossessed, sold, and the generated funds are used to repay a debt to a creditor, bank, or the IRS. A tax lien also affects the taxpayer ability to sell existing assets and obtain credit. The only way to release a federal tax lien is to fully pay the tax owed or reach a settlement with the IRS. The IRS or reach a settlement with the IRS. The IRS has the authority to seize a taxpayer asset who ignore a tax lien. Typically, the IRS use liens to delinquent taxes as a last resort, following all other options being exhausted, such as collection, installment, repayment, plans, and settlement. Following all other options being exhausted, such as collection, installment, repayment plans, and settlement. Mm, this concept of lien is something fucking important, man. The concept of lien, and this comes is because during the market contraction and expansion in the downturns and recovery, see that the U.S. equity market has passed through several uh, bear and bull markets, and the most severe start at the beginning of the Great Depression, where the recovery took 12 fucking years. Okay, recovery took 12 years, and the stock lost over 80% of their value. 83.4% specifically. Jesus. Okay. Okay. Oh yeah. Oh my god. Oh my god. Mm. Mhm. Very, very, very interesting. It's like, interesting. Very, very, very interesting. Okay. And uh, more recently, in the early 2000s, when the stock lost 44.7%, the recovery period took 4 years, the second largest in the US economy, the US history. And in the 2007-2008, with the banking and debt crisis, the recovery took over 3 years. And the pattern here is the time that is taking to recover. Okay, that recovery period. And because I'm living here, or I live and currently living the coronavirus, the COVID 19, to me was like, oh, okay, that's interesting. I don't have that much of that. I don't have that much of time to wait for the market to miraculously do what it has to do, to recover itself. No, 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 no. All right. And once I look at that, all right, then I saw is the the market contraction or the market downturns and recovery with respect of asset classes, such as stocks, bonds, some other asset classes, and with some sample portfolio, which is what I'm gonna look at this, and also the correlation of different assets with a broader market. So, looking at bond yields during recession, they are driven by factors such as the supply and demand for loanable funds, the uh, the policy, the monetary policy, and expected inflation. The Fed has a couple set, or the Fed has its primary tool to regulate the monetary supply, or to set the monetary policies with the discount rate and the federal fund rate. So the discount rate is something that I mentioned. Okay, is either the interest rate that the Fed charged to banks for short-term loans, and or it is the rate used in the discount cash flow analysis. And this is just an evaluation method to see what is the current value of an investment based on its future expected cash flow. So when I look at the cash flow concept, which is the movement of money in and out of the company, and C is that there are several type of cash flow from operations, investment, and financing. And to understand, to at least getting the basic of uh, how to read financial statement from the SEC, once I look here at the cash flow here, okay, and to understand this, the beginner guide of financial statement from the site, okay. Here, the beginner guide, so they mention is that if you're able to read nutrition labels or baseball or soccer box score, you can understand and read the basic financial statement. If you can follow a recipe or apply for a loan, you can get basic understanding, or you can get basic uh, accounting understanding, right? You can learn the basic of accounting, and the basic aren't difficult, and they're rocket science. So that section here from the set, they show you how to gain basic understanding on how to read, or of how to read financial statement, just like a CPR class, which is something that I didn't know, or I haven't received in eons, right? So just like a CPR class teach you how to perform the basics of cardiopulmonary resuscitation, this section will show you how to read basic part of financial statement. That will make you, or that will train you to be an accountant, just like a CPR uh, class won't teach you how to be a cardiac doctor, but it can show you, uh, but it should give you confidence when you look at a set of financial statements and make sense of them. Mhm. So it should give me confidence when I see a set of financial statements and make sense of them. It's like, what the f am I looking at, right? So this is show. So financial statements are, they show you the money. Just like a Cuba Gooding Jr. immortal lines from Jerry Maguire. Okay, just like this, just like Cuba Gooding Jr. immortal lines from Jerry Maguire. Show me the money. Mm, I haven't seen that or hadn't seen that movie, but I know that that exists. Oh, so show me the money, right? So that was financial statement do. So they show you the money, where a company money came from, where it went, and where is it now. And there are four main financial statements. You have balance sheets, income statements, cash flow, and shareholder statement of shareholder equity. So in Spanish, you might in Spanish is balance sheets, hoja de balance. Income statement is declaración de ingresos. Cash flow statement is declaración de flujo de caja. Statement of shareholders equity, patrimonio. So balance sheet show what a company owns and what it owns at a fixed point in time. Income statement show how much money a company made and spent over a period of time. Cash flow statements show the exchange of a company between or the exchange of money between a company and the outside world. Okay, it's the exchange of money between that company and the outside world. Again, over a period of time. And the fourth financial statement called a statement of shareholder equity. Mhm. The fourth financial statement called a statement of shareholder equity to show change in the interest of company shareholder over time. Now, uh, so the balance sheets again it shows you what a company owns and what it owns at a fixed period of time. Meaning, so in the balance sheets you can see detailed information about the company's assets, liabilities, and shareholder equity. And they describe these assets are things that a company owns that have value, and the value is something very, very, very contextual. Okay, and this typically means they can either be sold or used by the company to make products or provide service that can be sold. Asset includes physical property such as plants, trucks, equipment, and inventory. It also includes things that can be touched but nevertheless exist and have value, such as trademarks and patents. And cash itself is an asset. So our investment a company makes. Important things like asset includes physical property such as plants, truck, equipment, or inventory, or uh, things that can be touched but nevertheless exist and have value, such as trademarks and patents. So what I'm doing here is creating is a trademark, and this is something that has value for myself and for the others as well. So and cash itself is an asset. Well. Not if you live in Argentina, Venezuela, or any country with a high inflation rate. So our investment a com- so our investment so our investments a company makes, and liabilities are the amount of money that a company owes to others. This can include all kinds of obligations like money borrowed from a bank to launch a new product, rent for use or building, money owns to suppliers and materials, payroll a company owns to its employment, environment cleanup cost, or tax owed to the government. Liability also include obligations to provide good or service to customers in the future. And the shareholder equity is sometimes called capital or net worth. Interesting. So the shareholders' equity is something called capital or net worth. It is the money that will be left if a company sold all of its assets and paid all out of its liability. This leftover money belongs to the shareholder of the owners of the company. A company balance sheet is set up like the basic accounting equation shown above. On the left side of the balance sheet, company first company lists their assets. Okay, the TLDR is that a balance sheet shows you a detailed information about company's assets, liabilities, and shareholders. Okay, and with that, I will see you in the next video. Take care. Bye bye.